To begin, welcome to our deep dive on the Backdoor Roth IRA and why timing matters. In this video, we'll unpack how delaying your conversion across calendar years can complicate taxes, increase the chance of administrative error, and potentially create unexpected taxable income. As we move forward, we'll explain how Form 8606 shows up in two separate tax years, how to carry over basis correctly, and why immediacy is usually your best move. Next, here's our roadmap. First, we'll review how a backdoor Roth works. Then, we'll explore why delaying across calendar years is risky. After that, we'll detail how Form 8606 reporting splits and how gains get taxed. Subsequently, we'll cover best practices with a clear step-by-step, followed by diagrams and timelines. Finally, we'll test your understanding with short quizzes and wrap up with key takeaways. Before we proceed, please note this is educational information only and not tax, legal, or investment advice. As you continue, consult the IRS instructions and a qualified tax professional for guidance specific to your situation. With that said, let's jump into the essentials. Now let's clarify the basic mechanics. A backdoor Roth IRA typically involves making a non-deductible contribution to a traditional IRA, which creates after-tax basis, and then converting those funds to a Roth IRA. Form 8606 is the key form that reports both your non-deductible contribution and the conversion, ensuring you're not taxed twice on the same dollars. However, the pro rata rule aggregates all your traditional, SEP, and simple IRAs on December 31st of the conversion year. If you hold any pre-tax IRA dollars at year-end, a portion of your conversion could become taxable. Therefore, many people try to avoid pre-tax balances by moving them into an employer plan, if permitted. With the basics in place, we can explore why timing across calendar years becomes an issue. Moving on, this flowchart illustrates the ideal same-year sequence. You contribute non-deductible dollars to a traditional IRA, briefly wait if your custodian requires, and convert to a Roth IRA in the same calendar year. Then, you file one Form 8606 for that same tax year, which will show your basis in Part 1 and your conversion in Part 2. The decision point asks whether you have any pre-tax IRA balances as of December 31st. If you do, the pro rata rule applies and part of the conversion becomes taxable. If you don't, the taxable portion is typically minimal, aside from any gains accrued between contribution and conversion. This consolidated same-year approach keeps reporting straightforward. Next, here's the core risk of delay. If you make the non-deductible contribution in one calendar year but wait until the next year to convert, you must split the reporting. You'll file a Form 8606 for year 1 to report the basis from your non-deductible contribution. Then, in year 2, you'll file another Form 8606 to report the conversion and correctly carry forward your prior year basis. This split significantly raises the potential for administrative mistakes, such as forgetting to carry basis or losing track of documents. Additionally, any market gains between the contribution date and the conversion date will be taxable in the conversion year. Therefore, the simplest approach is to complete the full sequence in one near-immediate motion when you're ready. Meanwhile, this timeline shows a classic cross-year scenario. In December 2025, you make a non-deductible traditional IRA contribution and establish basis. In early January 2026, you convert to a Roth IRA. When you file taxes in spring 2026, you include a 2025 Form 8606 to report the contribution and basis. Then, when you file in spring 2027, you include a 2026 Form 8606 to report the conversion, making sure to carry over the prior year basis. Any market appreciation between the late 2025 contribution and the early 2026 conversion becomes taxable in 2026. And importantly, the pro rata rule evaluates your total IRA balances as of December 31, 2026, which can affect the taxable portion of the conversion. Continuing on, this table summarizes the split reporting workflow. In the contribution year, you report your non-deductible traditional IRA contribution on Form 8606 Part 1, which establishes and tracks your after-tax basis. Then, in the conversion year, you report the Roth conversion on Form 8606 Part 2 and carry forward your prior year basis to avoid double taxation. Be meticulous with records so your basis carryover is accurate, and be aware that any growth between contribution and conversion becomes taxable in the conversion year. Next up, this side-by-side comparison highlights why many experts prefer the same-year approach. With a same-year execution, you typically deal with a single return and one Form 8606, reducing error risk and keeping your documentation simple. Conversely, a cross-year execution requires two returns and two Form 8606 filings, plus an accurate basis carryover. This added complexity increases the odds of administrative mistakes, and any gains that occur while you wait will be taxable in the conversion year. Now let's walk through a clean, same-year execution. First, confirm you're ineligible for a direct Roth contribution based on income. Next, ensure you'll have no pre-tax IRA balances on December 31st of the conversion year. If needed, discuss rolling pre-tax IRA funds into an employer plan. Then, contribute non-deductible dollars to a traditional IRA and document the contribution. Convert to a Roth IRA soon after, keeping the amount aligned with the contribution to minimize gains. Track any small gains because they will be taxable upon conversion. Finally, file one Form 8606 for that year, completing both Part 1 and Part 2 properly, and keep all statements and confirmations for your records. Quick knowledge check. Question: if you contribute to a traditional IRA in December 2025 and convert to a Roth IRA in January 2026, in which year's tax return do you report the non-deductible contribution? Options: A. 2025 tax return, B. 2026 tax return, C. split between both returns, D. it doesn't need to be reported. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. You report the non-deductible contribution on the Form 8606 for the year in which you made the contribution, 2025 in this case. Separately, you will report the conversion on the Form 8606 for the year you converted, which will be 2026. Next, another quick question. What happens to market gains that occur between your contribution date and your conversion date? Options: A. They are tax-free forever. B. They are taxed upon conversion. C. They are taxed only if you have pre-tax IRA balances. D. They are taxed in the contribution year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Any gains that occur between your contribution and your conversion are typically taxable in the year of the conversion. Additionally, if you have pre-tax IRA balances on December 31st of the conversion year, the pro rata rule can affect how much of the conversion is treated as taxable. As we near the end, remember these practical tips. Execute contribution and conversion close together to reduce complexity and potential tax on gains. Maintain excellent records, including statements and your Form 8606 filings, and always track basis from one year to the next. Avoid having pre-tax IRA balances at year-end of the conversion year to minimize the impact of the pro rata rule. If you must cross calendar years, double-check both returns and the carryover of basis. Finally, when uncertain, consult a qualified tax professional. In summary, crossing calendar years is permissible, but it splits. Form 8606, reporting across two separate returns, and raises the risk of administrative errors. They'll report the basis in the contribution year and the conversion in the conversion year. Any gains between contribution and conversion are taxable upon conversion. A same-year approach typically makes life simpler, reduces the chance of mistakes, and minimizes unexpected tax outcomes. Keep thorough records and consult a professional when needed. Finally, thanks for watching. If this helped clarify backdoor Roth timing, please like the video, share it with someone who might benefit, and subscribe for more clear, actionable money content. We'd love to hear your experiences and questions. Leave a comment so we can help you and others in the community.